History suggests that stocks won't like inflation, says my boys over at Real Investment Advice. What is this? Our realinvestmentadvice.com. Such a big fan of these guys, these firms. I don't know what I don't know if they are an RIA where you're paying for investment, but I don't know. But I like their blog. It's one of the best blogs out there for sure. This is my boy Lance Roberts. Never met him, don't know him, he doesn't know me, but I'm aligned with much of what he says. All right, so let's start with this. Let's start with a bullish spin from Dimensional Fund Advisors, DFA. All right, because several articles lately published suggest that stocks will perform well in higher inflation. That may be the case when inflation rises to more robust rates of substantial economic growth. However, history suggests rising inflation not only negatively impacts economic growth, but triggers adverse market environments. Well, I could not agree with that. If you're wondering what I'm doing, like Finney's over here sniffing at something. All right, so DFA. This is like the global warming people. So let's read this right here because I want to give them their credit. Will inflation hurt stock returns? Not necessarily. And look, since 1991, one-year returns on stocks have fluctuated widely. Yet weak returns occurred when inflation was low in some periods, and 23 of the past 30 years was positive returns, even after adjusting for inflation. And they're going to show us going back all the way back to 1991. And you'll see inflation is red. So inflation has been below 5% every single year, except for where we are right now. That's the same thing as cherry picking the data on climate change starting in 1979, which is what they do. It's freaking stupid, man. I mean, that's just. All right, let's keep going. Since 1991, the period they chose to represent the market, the S&P posted an average return of 8.5% net of inflation. However, even going back to 1926, the annualized inflation-adjusted return on stocks was 7.3. So as DFA suggests, investors should not worry about inflation as stocks outperform inflation over time. The problem is the cherry picking of starting points. The climate change freaking demons do this. They're demons, man. Demons do this all the time. Average and required returns aren't the same, 100%. The problem with average returns is the vast difference between average and average returns over a given period and required to meet financial goals. As we discussed in The Best Way to Invest, there's a massive difference between average and actual returns on invested capital. Thus, in any given year, the impact of losses destroy the annualized compounding effect of money. This is why I always say stocks for the long run, you never hit the long run. You're always in the long run. So they say, well, stocks are less aggressive, less risky over time. You're always in the short run. You will never you're chasing the dragon like a heroin dragon. The long run, the long run, and yet your whole capital is being depleted right in front of your very eyes. If your capital can hold out, you'll probably do just fine in the long run. The problem is, will your capital hold out if you're pulling money out? No, it's not. Someday never comes. The long run never comes, to quote CCR. All right, so the chart below shows the difference between actual investment returns and average return over time. The purple shaded area in the market price graph show average rates of return of 7% annually. However, the returning gap in actual returns due to periods of capital destruction is quite significant. Here's the average. Here's the actual. This is going back to the whole sequence of return risk thing. You can look at any data set and you say sequence of returns. We have an average 10% every year going back for 30 years. All right. Well, you flip those over on themselves, you still have an average 10% rate of return. The problem is you ran out of money in year 14. You weren't able to capture the averages because your capital was depleted. I just 100% agree with that. All right, let's keep going. The two other problems with dimensionals analysis. Since 1990, the first data point used for the bullish case, inflation has steadily fallen. Interesting. Interest rates are falling. Interesting. What does that do for bonds? Oh, they go up. What does that do for stocks? It goes up because the stocks go up when interest rates go down. I'm not all the time, but bonds do, stocks do. That's why they keep the interest rates low, to inflate the asset economy, where the rich people are. Such gave a significant boost to equity as input costs fell, increasing corporate profitability. When debt price to service your debt goes down, you have more profits, more spending power. You can do what? Buy back more shares. Interesting. Which has been a significant reason why the markets are going up, because of share repurchases. Why? Because there's more profits, because they're borrowing, the cost to borrow is less. More importantly, however, returns were heavily front and back end loaded, masking the near 13-year period of zero returns right here. I could not agree more. So from 1990 to 1999, huge returns. From 2011 to 2021, huge returns. But we had 13 years of nothing. If you're pulling money out of there, you're in a world of hurt, man. The second problem stems from the use of 1926 to the present time frame. While using such a time frame certainly paints a very bullish picture, the reality is that if you died somewhere around the early 1950s, the reality is that you died somewhere around the early 1950s if you started in 1926. Such sounds great until you realize you barely got back to even following the Great Depression of 1929, 100%. As noted, there's a massive difference between an average rate of return and what actually happens to your money during bear markets. History of inflation and markets. However, the history of the longer term of inflation helps determine the impact on the economy and the market over time. Not surprisingly, as shown below, spikes in inflation have been coincident with crisis events throughout history, from banking crisis to economic recessions to devastating bear markets. Inflation spikes trigger revulsions. And so to use this right here, there has been no massive inflation hit at all, none whatsoever. So to use that to say this is what will happen for inflation for stocks is freaking idiotic, man. But we know 1973 and 1974, let's see, right here, massive inflation as stocks got pummeled right there. Stocks pummeled, 1973, 1974. Here's a Great Depression, which is deflation. Stocks got pummeled. So there's no correlation between deflation or inflation of stock performance. They're just not. However, if stocks are based on two things and two things only, which Jack Bogle has taught us, earnings growth year over year plus dividend yield, e.g. YOY plus dividend yield. If earnings growth goes down, guess what? Guess what? Stocks most likely will go down too. It's just that simple, because they're not making the cash flow to justify the high metrics. The current spike in inflation is still minor relative to historical triggers, but it's worth watching closely. Earlier this year, the primary belief from the Federal Reserve was the inflation was transitory and would quickly resolve itself. I thought so too, until I recognized what they're doing to the price of energy. Now Sniffy Joe is trying to shut down more pipelines. Are you freaking insane? Crazy. Let's see. As the big problem when it comes to the stock market is margin compression. The earnings being squeezed, and yet the prices are still high. So the prices are high now, and the earnings are being squeezed. That means the prices are higher. The margins are even higher. The multiple, I should say, is even higher, which makes it even that much more nosebleed. In 6 of the 7 inflationary periods, including both episodes of the 1970s, corporations experienced margin compression. The era of moderate inflation following the 2008-9 recession was the only period where margins improved. Profit margins are now at their highest since at least 1947. If inflation continues higher and margins decline, profits will suffer. If earnings decline due to declining margins and valuations fall to levels in line with prior periods, stocks can easily fall by 40 to 50%. Finnegan. Even more significant declines would not be abnormal. Yeah, 100%. So here, I hate to use the cape. I don't know. I'm not a big fan of the cape. I am a big fan of PE ratios when you're looking at earnings to prices. If you get compression of earnings, you're going to have a drop in prices. It's just, look, I can't guarantee that, but it's just common sense. The biggest problem is the Fed won't be able to bail investors out, 100%, man. So anyway, let's see what these guys' YouTube channel is. What are you sniffing at, Sniffy McGee? So let's take a gander, shall we? I love you, big boy. And I am already subscribed to these guys. I don't think they do that many videos. At least I don't get them on a notification here. Oops, what did I just do? All right, so well, they put 45 videos out the last 30 days. Not getting me no more. Okay, interesting. Yeah, so it's yeah, that's interesting. I have to look at what there's Leibowitz right there. All right, so they're not getting that many views. I mean, I'm getting more than they are. It's weird, but that's cool. I like it.
I am Lance Roberts. Welcome to our Real Investment Show YouTube page.
Yeah, there's Lance Roberts. Cool, man. Good stuff. So you should subscribe to their website, their YouTube channel for sure. They only got 9,000 people, but good stuff. Like your thoughts. Thanks now.